Hey, what's up guys? Eric here. I've got a quick video today. I've had a lot of people, especially recently, ask me, hey Eric, what are your favorite dividend ETFs? I want to invest in more dividends and I'd like an ETF. To be honest with you, there's not a lot of great ones. There's a handful. Today I'm going to give you my two favorite dividend ETFs. I'm going to show you why. And I'm going to do a comparison and compare them side by side, show you how many holdings, what the difference in expense ratio is. I'm actually even going to look and show you the overlap between which stocks actually overlap that are in both ETFs. And then I'm going to give you my opinion of which one I think is the better buy. The nice thing about these is they work really well for periodic investing. If you're going to periodically DCA or dollar cost average into a portfolio or retirement fund, you're going to want to see these two. And I think it'd be really interesting to see the breakdown and the comparison. Stay tuned. So this is ETF.com. It's a free tool. I encourage you to check it out, ETF comparison tool, and you can compare different ETFs side by side. We're going to look at today SCHD. That's the Schwab US Dividend Equity ETF, and then VYM, which is the Vanguard High Dividend Yield ETF. Now, if you look at these, they're very similar in terms of the expense ratio. They're about 0.06%. If you look at the assets under management or the AUM, they're pretty close, 34.19 billion for Schwab, 42.85 billion for Fidelity. Average daily volume, about the same, 250 million, a little bit more volume actually on the Schwab. This is where it starts to get really interesting and they start to separate. 100 holdings for SCHD and 442 holdings for VYM. So that's a big discrepancy. The performance, this is really odd. You've got exactly negative 5.12% for each of those in a month, which I think is kind of strange because they're very different ETFs, 100 holdings versus 400 holdings. If you look at the 10-year performance, you can see SCHD has actually outperformed 13.5% to VYM 11.4%. And you might look at that and say, well, that's because the Vanguard one has a higher dividend yield, but that's actually not even the case. I'll show you here in a second, so stay tuned. 100 and 442, and you can see a quick breakdown of what's in them. So you got Merck and Company is the number one holding for SCHD. Johnson & Johnson is the number one holding for VYM, and it breaks it down here. So you've got things like Exxon, JP Morgan, AbbVie. You've got a big range, really. The top weighting is 22.96% on this one and 41%. So SCHD has less holdings and higher concentration. So this is VYM, and this is showing you all the holdings. You can see there's a lot of really small holdings. Some of these are only 0.1%. It might be hard to see this, but I just wanted to give you an idea of just how many holdings. There's a ton of them, and a lot of them don't really have, much value. They don't really have a lot of weight in the basket of stocks. So it's kind of interesting when I look at it and say, well, why do I need to have a bunch of stocks that are 0.1%, 0.01%? The answer is they're just trying to hedge it as best they can with lots of different stocks to give variety in there, and they have lower concentrations than SCHD. Let's look at SCHD really quick so you can get an idea of what's in that one. Okay, so SCHD, 104 holdings, and you've got significantly more weight, 4%, for Merck. You got Amgen, Pfizer, Coca-Cola, Pepsi. You can kind of see IBM, Broadcom, a little bit more tech. The two together work really well. And a lot of people like to buy both SCHD and VYM together and use that kind of strategically to hedge each other. You could argue you probably don't need that much hedging, but if you're in capital preservation mode, the more the better. You saw earlier though that in 1 month they're both down exactly 5.12%, so it might not matter that much. The same kind of deal here, and it's interesting because you look at my portfolio, and my portfolio is like this too. I've got a lot of holdings that are 0.5%. I don't have a lot that are 0.01%, but it's not uncommon when you look at ETFs to have some of these smaller holdings. And a lot of people, when they build their portfolios, they think that they have to have at least 1% or something in each stock, and you don't. You really don't. Okay, SCHD has 3.1% dividend yield according to Fidelity here. It's trading at about $70.46 per share. It's got an A rating, 5-star from Morningstar. What I think a lot of people are surprised by is that VYM actually has lower dividend yield, and it's called the High Dividend Yield ETF. It has a 2.72% dividend yield versus 3.1% for SCHD. They both have A ratings from FactSet, but you'll notice that Morningstar is only a 4-star in VYM, and it's a 5-star for SCHD. So this is ETF Research Center. You can also Google this and you can find it. What's really cool is it'll show you a fund overlap. So this is going to compare SCHD and VYM, and show me the overlap. And this is a really powerful tool. So 89% overlap, but they're comprised very differently. And you can see here, the blue is the Schwab and this gray color here is the Vanguard. And if you look at the sector drift, you take SCHD minus VYM, you can see tech. Here's the difference here. Tech 10.4%, industrials 2.3, staples 1.5, communications 1%, financials are about par. So Home Depot, the weight in the Schwab one is 3.7%. VYM is 2.2%. They have an overlap of 2.2%. Pfizer's the next one. You've got 4.2% in Schwab, 2% in VYM. That's a 2% overlap, and so on. You can see Pepsi, Coca-Cola. So it makes sense that those would be in there. Those are higher dividend, higher quality companies, that they'd both be in there in higher weight. But the weight's quite a bit different. You look at Pepsi, 4.2% in the Schwab, and only 1.6% VYM. So VYM is trying to take the top 400 stocks that have yield, what they consider high yield, and it's diversifying it. Now, where that could be a positive is if I'm trying to preserve capital and I want to have a lot of different holdings. So in other words, if one of those companies went belly up, if you have 100 holdings, it's going to impact it more than if you have 400 holdings. But you could argue that 100 or 400 is still hedging you very well. It's a way to basically hedge the ability to get that passive income on dividends without having the individual stocks. Because if you have the individual stocks and the stock goes down 50%, well, especially if it's in a retirement account, then you can't tax loss harvest it. So it's a way to kind of hedge that and really simplify it. Because it's one thing, like if you look at a portfolio and you can have 10 stocks that are red, 10 stocks that are green, and you see that it's either up 5%, down 5%, but you see all the kind of the ingredients that make the casserole, so to speak. And sometimes it's kind of ugly under the hood. With an ETF, you just see the one number. You don't see the pluses and minuses for each stock. You just see, hey, I've got a basket of stocks and it gave me a 10% return and it's paying me a 3% dividend. So there is some peace of mind in that, especially if you're looking for that passive income, that retirement income. And I think it makes a lot of sense to have a good chunk, once you're in that capital preservation stage, a good chunk of your income to be in dividend ETFs like this. So it's important to bring it to the channel, to break these down and to discuss them with you guys. All right, so if you had to choose one ETF, which one would it be? I'll get to that in a second. So what are the main differences here? Starters, of course, one's Schwab, one's Vanguard. One was launched in 2011. So the Vanguard is actually older. It's been around since 2006. They both have 0.06 expense ratio. We know that Schwab pays a higher dividend yield. We also know that Schwab actually has outperformed pretty consistently. And I guess I want to point out the reason why that might be. So if you look at the investment approaches, they're very different. SCHD seeks out high value companies with a history of consistent dividend payout and higher profitability balance sheets. VYM, on the other hand, seeks out higher than average stock yields with the exclusion of REITs. So VYM doesn't have any REITs. VYM is also going to have less technology. And VYM is really trying to focus on a higher yield. Now, what's interesting about that is their dividend yield right now is actually less than SCHD's yield. So for VYM, they're really focused on companies that are paying out higher dividends. And sometimes the quality is not there. And these stocks have been hit. Some of these high yield, high dividend payers, they've been whacked pretty hard. And it's actually impacted the ETF. So of course, with all that said, if I were to pick one, I think by a mile, it would be SCHD. I think it's a higher quality ETF than Vanguard. Now, again, Vanguard, the VYM, would have some benefits if you're trying to hedge with more stocks, because again, in theory, if Schwab has 100 stocks and they're highly concentrated, only a handful of stocks make up about half of that portfolio in the ETF. If one of those companies, one of those stocks cuts their dividend, that could impact it. If one of the companies lost 50% of its stock value, that could impact it. But so far, it's proven that the methodology behind it, the higher quality companies, that's proven to outperform VYM, and I think it's a better ETF moving forward as well. This video is sponsored by Motley Fool. If you want to see the 10 best stocks to buy now, visit fool.com/firedupwealth. Please subscribe to the channel. Please drop a like and a comment. Thanks for your time and attention. Have a great rest of your day. Take care.